Welcome back to the Market Matrix, and today we're speaking about the ascending triangle. So, throughout all the other patterns we spoke about, some of them consisted of some triangles. So, we went over the bullish pennant, which was something like this. This is a triangle over here. Price action got tighter and tighter and tighter. We went over the falling wedge, which was something like this. Price was getting tighter, tighter, tighter. We had the rising wedge, something like this. Price was getting tighter, tighter, tighter. We had the broadening bottom, which was a little bit different because it was like this, but it's still sort of a triangle if you look at it like this way. Anyways, now all these patterns, what they consisted of was price getting tighter within it, whether it was a triangle like this or a triangle like this. Now let's go over this triangle and see what it's about. So the stock runs up and then it gets rejected and it pulls back, gets rejected again and pulls back, gets rejected again and pulls back. If you notice at this point, what's going on is rejected over here, rejected over here, over here, over here. It's rejecting basically at the same level. So let's call this $4. This stock is constantly rejecting at $4, meaning there are sellers constantly coming in at $4. Let's say the price is 1 over here. Where are the buyers stepping in? The buyers stepped in over here at 1. They stepped in a little higher at this time. Let's call it 2. And let's call this 3. So the buyers are stepping in every time the stock pulls back, and they're stepping in sooner than they were initially. So over here, they stepped in at 1. Over here, they stepped in sooner. They stepped in at 2 when the stock was pulling back. Over here, even sooner, the stock was at, like, let's say 3, and they stepped in over there. But what's going on with the sellers is they are consistently selling at this same price, and buyers are not able to push the price above here. So once we see that the ascending triangle is formed. Again, wide price range, buyers stepping in, buyers stepping in, buyers stepping in. Price is getting tighter. So this is what you will see. The price is getting tighter and tighter and tighter until eventually the price where the buyers are and the sellers are very similar. Over here, sellers were at 4, buyers were at 1, buyers were at 2, buyers were at 3 up here. So it's getting tighter and tighter and tighter until something has to happen. But before we get that something to happen, we should anticipate a move. So what we're going to do is we're going to measure a move. So that way when the move we're anticipating happens, we have an idea of where it should go or where it can go. Again, these measured moves is not where it absolutely will go. It's where it can go, where we should expect it to go. A lot of times it'll have this measured move. But let's say something halfway there, something happens, I don't know, news comes out or sellers just start to get aggressive and this thing goes down. You should prepare for that. You should be able to adapt for that. But for now, let's look at this. This is the move we should expect. The move from the lowest point of trend support over here, again, where the buyers initially started stepping in, if we're talking about buyer-sellers aspect of it. But it's going to be the bottom, the low point of this trend support. Again, this is a trend over here. This is the trend. This is trending higher. So the bottom point of this trend support, we measure that up to the resistance where this was constantly getting rejected. And that is the move we're going to expect. And where we're going to expect that move? Above here. Above this line over here. So once we know that, we could get to the entry. But here's the thing with this pattern. I'm not going to tell you that this is a solid entry for this for this pattern. A lot of people trade this pattern in a lot of different ways. What some people do, which is, I guess we can call it more aggressive, is enter once this breaks and closes above this trend resistance over here. What some people do even is once it breaks, they don't even wait for it to close. They enter once it breaks this trend resistance, which I personally don't think that's a good idea to instantly get in once it breaks. At least wait for it to close if you're going to trade it this way. Why? Because this candle, remember, we already spoke about candles. So this candle at some point, this opened over here, closed over here, had a high over here, and had a low over here. At some point, this candle may be open like this, went all the way up here, and went all the way back down. So all it looked was a red candle like this, basically. So waiting for this candle to close gives you a better idea of the price action that occurred during the time of this candle. So if it was a 5-minute candle, it'll tell you what happened within the 5 minutes. We already went over this. But waiting for the candle to close, if you're going to take this aggressive entry, is better off than just waiting for it to break. At least if you're going to be aggressive and wait for it to close, then you know that it closed above there. The price closed above the price over here, which it failed to close at 1, 2, 3, all these times. So that's one way people trade this. They like to enter upon it breaking and closing above here. Another way, which I sort of like better, but you won't always get this, is this retest over here. So it breaks above this. It breaks above this resistance, and then it comes back down, and then it holds this resistance as support. So we spoke about this where a lot of times support will become resistance, resistance will become support. So this was resistance over here, resistance over here, resistance over here, resistance over here. Broke it here, now it's coming back down. If this holds as support, I will see that as better confirmation than just having this candle close above here. Because a lot of times what happens when something like this happens is the people with the big money and all the market makers, they can see our orders. So if they know, let's say this is $4, and we have, let's say I'm a trader who's going to be aggressive and take this entry. Let's go back to this to the example. Let's say I'm an aggressive trader who's going to take this entry at 410. Let's say $4.10, and this is at 4 over here. So I have a buy order set for $4.10. Now the market makers, these are the people who basically fill our orders. We're able to get all our orders filled through our brokerages and all the transactions and everything. Now, if they see our orders at $4.10, and they are in the stock already from over here, or even over here, they can make 10 cents and still make a decent amount of money because of the amount of shares, the size of money they are using. So, if they see your orders at 410, why don't they just take your order and take advantage of that information that they have? If you see if they see you're willing to buy at 410, why don't they just sell it to you? They see, let's say there's a bunch of people willing to buy at 410. Okay, cool. And they have that amount of shares, let's say at 390. Why don't they make that 20-cent difference? So what they'll do is say, okay, I see this person's already has their order set to buy at 410. I'll put the order through. I'll give it to them at 410. I have it at 390. So what happens a lot of times is a fake out. They break it above here. They send it higher, filling your orders. Meanwhile, those orders that you're being filled buying the stock is where they were selling. So the selling pressure gets so intense that this just comes back down, basically. This is called a fake out, where a lot of people, they get in over here on the breakout. Again, the market makers see your orders. So a lot of people will get faked out, thinking it's going to go up. They get in over here, and then it just gets sent back lower, and the market maker made his 20 cents or whatever the case was. So this is why I personally don't like this entry. I tried trading it initially when I first started in the markets, and then I realized a lot of times it doesn't work, and then I was wondering why, and then I realized why. So a lot of times it works. Sometimes it works. I'm sorry, not a lot of times. Sometimes this works, where this thing will keep going and going and going nonstop like it did over here. But I'm willing to take my chances of missing out on this for something like this, where I know that this is holding as support at this point. And if it breaks below, then at least I didn't buy it all the way up here. I waited till it came back over here. But I like this setup better than just where it broke out. So there's people that trade it like this. They enter over here. Now, there's also people who really want to see confirmation. So they're willing to pay a little bit more. They're willing to get in at a higher price. And what they do is they wait for this break above the resistance, the retest of this resistance as support now, and now they want to make sure that the price keeps going in their direction. They want to make sure that this retest over here isn't just going to fade away and go back down. They want to make sure this thing is going to keep going. So what they'll do is they see, okay, this is resistance over here. This was the high of the breakout. What they wait for is a break above this high of the breakout to know that they will get a follow through. So a lot of people do that as well. Again, the style you use is going to align with your trading style, your risk parameters, what you like, how you like to trade it. At the end of the day, some people, they like to be aggressive. As soon as something breaks, they want in. Some people want confirmation. As soon as something retests, they want in. So this is one of those patterns where if I tell you there's a specific way to trade it, then I won't feel comfortable. Just because, again, this depends on your style of trading. So either one of those can work. some of them might mess with your psychology because, like I said, this over here, it can break out and then fake out and go back down. But any of these can. Even this one can. Waiting for this. Even waiting for this to happen. This can mess with your psyche because they could fake it out after that. But that is just a matter of a trade going wrong, which happens sometimes. And you need to expect that anytime getting into any trade. You have to accept that. So, depending on the style you like, I like this one. I like this one. The one we saw before this. I like this over here because at this point I know it broke out. And I wouldn't mind waiting for a retest. And if it retests and it holds, then I feel comfortable because I know it's holding this as support at this point. And if it goes south, I cut the trade. And if not, I got it at a decent price. But that's just me personally. So we already measured the move, if you guys remember. So wherever you got it, if you got it over here, if you got it over here, if you got it over here, you still managed to make money because you end up riding this whole wave. And that is that. Thank you again for watching this video, and hopefully I'll see you in the future videos when we speak more about other candlestick patterns and candlestick formation, support resistance, and a bunch of other things, and we dive more into the market matrix.